meeting of the Audit Committee and welcome everybody. And I would ask the clerk to call the roll, please.
Certainly. Good afternoon, everybody. Trustee Bartholomew.
Yes.
I don't believe Trustee Kane has joined yet. Trustee Donnelly. Trustee Irwin.
Yes.
Trustee Gardner.
Yes.
Trustee McMahon.
Yes.
Trustee Martin.
Yes.
Trustee Mishu.
Yes.
And we do have some trustees that are joining that are not committee members. I believe we have Trustee Dobson, Cates, and Rotundo. So we were all set to start.
Just quickly, Emily Kane did join.
Oh, okay. Thank you.
Okay, well, welcome everybody. And if I could just remind people to leave their microphones muted when they're not speaking, it would help the process along. Tab 1 is the Department of Athletics agreed upon procedures report, and Samantha Hegman, I believe, is handling that.
Yes, good afternoon, everyone. For those of you that don't know me, my name is Samantha Hegman. I am our Associate Athletic Director for Compliance, as well as our Senior Women Administrator here at the Orono campus. So we had our annual agreed upon procedure with our firm O'Connor and Drew in July. And came out with only one finding and a few recommendations. The finding was as it pertains to a New Balance logo. However, we've told the company numerous times about it, and we have in turn, they do send us other patches that our equipment staff works with it. The other findings are, the other recommendations were already things that we had in the works, such as an inventory system for our equipment staff. We actually onboarded one, or will be onboarding one this upcoming summer and school year. And then the rest were around our M Club, and then as well as just some other kind of things to, tighten the reins a little bit here, putting things more formally in writing. We do this every year. It rotates every 4 years on the different subjects that they do oversee that we look at. This year specifically, it was our initial eligibility and continuing eligibility for our student athletes, as well as our extra benefits, specifically as it pertains to our athletic apparel and representative of athletics boosters, and our student athlete employment, which again, the recommendation we already fixed and are putting in place, have put in place this past academic year as we went through our beginning of the year meetings. So at this point, we'll open it up to questions if anyone has any.
Questions for Samantha?
Chair McMahon.
Yes.
My question for Samantha. Samantha, can you just tell us more about the M Club? It was access. It was allowing third parties basically access into it, and kind of putting electronic door cards or something in that capacity. Is that right?
So our M Club is our basically like alumni group. It spans pretty much generations, and they provide support for our student athletes, and that's run through our foundation. So all financial contributions go through the foundation, and we do not get anything directly to us through athletics. There are instances where, say we need a specific piece of equipment in the equipment or anything in sports medicine, we'll buy that, and then the M Club will donate that money to athletics to help fund that for our student athletes. But there is no like booster access, anything like that directly with our student athletes. And we do educate them on what it means to be an athletic booster and what they can and cannot do with our student athletes.
Thanks.
Could you just outline for us the process you use for selecting auditors? I believe you RFP'd for an auditor this year.
Correct. We did RFP for an auditor, and we went through the normal system process, and we selected O'Connor Drew, which we've had past relationships with. They were in the middle of the pack with their process as far as how much they charge, everything like that. We also use them for obviously our compliance audit, and then also for our business office audit. And it helps because the auditors that do come, they have a background in compliance, the lead one specifically. So for us, it's easy to work with them because we're not teaching them compliance and then trying to audit, or basically, you know, kind of, he understands what we do here at the university in an athletic compliance capacity. So it makes it easier for the audit process. Also too, a lot of times, at least from the compliance end, since it does vary every year, when we go through this process, we come out with them actually implementing more things and being able to kind of see any holes that we may have. And specifically for me, since I've only been here for 2.5 years, I'm still learning how we do everything at the system here at the university and through the system. So it allows me to kind of curtail our compliance department to what we need to do or what's missing.
Okay, thank you. Other questions on the UM Athletics agreed upon procedures report? Seeing none, tab 2, Audit Committee Fiscal Year 2022 Work Plan, Duties and Responsibilities. Tracy?
Thank you. The work plan before you really has been consistent with the prior year, except that we did add that annually you would receive, actually twice a year, the update on the enterprise risk management, which Gretchen does. But other than that, it's a rather routine item with the NCA coming several times a year with their reports as they come due, as well as the annual financial statement audit in the fall, like we're doing today, and with the single audit in the spring.
Okay, thank you. Questions? Seeing none, tab 3, OPEB plan. Linda Bonival from KMS Actuaries.
Yeah, and let me introduce her, if I may, really quickly, and then I'll work to do a better job on presenting the PowerPoint than I did this morning. So Linda Bourneville is the owner of KMS Actuaries, and this is her first time visiting with us today, which is surprising, being how long she's been around and supporting us. She is a credentialed actuary with over 30 years of consulting experience and has been working with the university valuing our retiree medical program since 2006 and our 2 defined benefit pension plans. She will be providing an overview of the fiscal 21 actuarial results and all the work that goes into that for her. And I'll turn the presentation over to Linda, if you're ready for me to share the PowerPoint, Linda.
Yes, I am. Thank you so much, Tracy. We'll wait to get that up there.
Okay. Oh, there we go.
Excellent. Thank you so much for having me here this afternoon. Again, my name is Linda Bourneville, owner of KMS Actuaries. We are a small actuarial consulting firm located in southern New Hampshire. And I'm really happy to be here. As Tracy mentioned, have never really participated in the audit committee meetings. Tracy and her group just do an excellent job relaying our results. But we had a bunch of changes this year that we thought might be worthwhile to go through and actually sort of like outline and give an overview of how the actual benefits that are provided to retirees impact the bottom line. So quickly, just going through our agenda, we're going to talk about what is this valuation and what is it for? Some key results that came out of the fiscal 2021 disclosure study. When we talk about an OPEB plan with an OPEB trust, what exactly does that mean? How are we doing? What is its funded status or its funded ratio? I'm going to go into a very high level overview of an actuarial valuation and exactly how we put that whole thing together. and then talk a little bit about the disclosures that we also provide. Next slide, Tracy. Really quickly, I don't need to go into this. These are just my credentials. This means I have a whole lot of letters next to my name. Spent a better part of my young adult life studying to be an actuary by taking their rigorous exams. And as I mentioned, our expertise at KMS really is in the public sector, where we do a number of retiree medical, like the UMS system, healthcare valuations. We provide accounting disclosures for any kind of retiree medical program. In addition to that, our public pension actuarial practice is robust. And we also do a fair number of audits of other actuaries of large state pension and healthcare systems. So that's our background on doing this work. Next slide. So as I mentioned, purpose of evaluation, we are engaged by UMS to provide a biannual valuation of the retiree medical or OPEB program. And what is OPEB? OPEB, the letters actually are other post-employment benefits. And the other just means that it's anything other than a pension plan. What we think of as a traditional pension plan, I work so many years, I get a benefit, monthly benefit paid to me once I retire. That might be based on your years of service and your salary. That is a very typical defined benefit pension plan. This is not that. The OPEB is the other benefits that are also promised employees upon retirement. And those generally include health insurance coverage. It could include dental or other things like that, or life insurance. So that is the definition of the other. And we collect a whole lot of information from Tracy and her staff and develop liabilities on all of the plan members. And we review the OPEB trust assets, and we make comparisons on all of these things. Every time we measure any of these liabilities under our standards of practice, we need to review those assumptions and methods to make sure they're continuing to be appropriate, they're consistent with each other, they're reasonable, and that they also conform to our actuarial standards of practice, or the ASOPs. With the results of that valuation, we can develop, a funding, based on a funding policy, contributions annually to be paid into the trust. And then we'll also, an important byproduct is the financial statement disclosures that will appear on the university's financial statements. So these are just some numbers, and all of these results are obviously displayed in great detail in our valuation report. We do one of these every year, even though we do evaluation every other year. The interim year also needs to be reviewed and looked at. We just don't collect a lot of the census data on the interim year. But here's the results for FY 2021. The OPEB trust assets. For many, many years, UMS has been setting aside assets, or they have made contributions to their OPEB trust. This year, ending June 30, 2021, as you can see, and in anybody's portfolio, the returns were quite satisfactory. We had over almost a 27% return on assets for that fiscal year. That resulted in a gain of over $27 million. And that means we expect a certain return on assets. We expect 7.25. That's our annual or year-over-year assumption on returns. That gain is what was received over and beyond the 7.25. So $27 million is kind of an over, extra assets included in the trust. We then value the liabilities, and the liabilities are really just, what is the promise? What is the present day value of that promise to all retirees and all future retirees? And where we are there, we're about $162 million total OPEB liability. So when we talk about a funded status or a funded ratio, we look at assets and we compare that to your liability. And as of June 30, 2021, we are actually over 100% funded. The funded ratio is 111%. So that means that there's about $18 million in excess assets at this point. Keep in mind, it's important to understand a funded ratio is a point in time, a one day. I say you could be 111% funded on June 30th, but maybe on July 1, that could be 99 or 80 or whatever the market might do. It is because markets change daily, right? Your funded ratio really, again, a point in time. It's not something that you're going to live with, forever. The 111, that will change over time. Tracy, next slide. This is really just a short history because OPEB reviews haven't really been going on for a long time. This is under a new GASB standard that we've been measuring under the way we're doing it now since 2016. Prior to that, back in 2006, the GASB sort of introduced this concept of measuring this promise or this liability that really has been made. You're making promises to active employees. So basically a type of deferred compensation, right, that is going to be provided to them if they stay and they work the required number of years, and that they will, stay and receive that benefit. So here's sort of a historical picture of our liabilities, the darker green shaded bars, the assets, and as you can see, they have increased pretty nicely over the years. OPEB some people call it the Wild West. It's a difficult number to pinpoint, so you can kind of see a little bit of like jagged edges. Pensions are easier to value because it's based on salary and service. Those things are generally pretty well known. OPEB, on the other hand, is based on health insurance costs, and we all know those are somewhat tricky to determine on a year-by-year basis. Tracy? So we have an OPEB trust. What does that mean? We have created an investment vehicle to make annual contributions, or more often, whatever, you can make them however you want. And its purpose is to accumulate assets so that in some future date, you're going to use those assets to pay these benefits. So you're pre-funding OPEB liabilities. There's criteria under the GASB standards in order to be able to recognize that trust in your financial statements. You actually have 3 criteria that must be met. The assets that you've set aside are strictly dedicated to providing benefits for retirees. There can be no other use for those assets. So that once the money goes in, right, the purpose is to pay OPEB and administrative expenses that go along with any OPEB program. The assets are legally protected from creditors of the employer. And of course, if you can only use them to provide benefits to retirees, once the employer contributions are in the trust, they cannot be taken out. They are irrevocable. Those are your 3 criteria. So we've got the trust set up. Now we need to determine, well, we need some kind of systematic method of getting that money in there, of pre-funding. We all have mortgages, and so you take, you have your mortgage, what you need to pay off for that. You have a plan. You have a mortgage that has a monthly payment plan, or anything. A pension system generally will have a funding policy, a way to get money set aside into that trust. An OPEB plan really is not much different from that. So you can develop liabilities on a year-by-year basis, have a funding policy in place in which you can pre-fund those benefits. Now, pre-funding the benefits might be a lot different into the trust than the benefits you're actually paying your retirees, right? There are some cost sharing things going on in OPEB. The system does not pay all of the retiree benefit that's being received. You have some retirees making contributions for those premiums. So you've got this sort of split between that. So you're paying some of those benefits, but you're also perhaps putting money aside into the trust. So you kind of got 2 pieces going on here. And so your total contributions, of course, are everything. It's the whole piece. And I'm going to get into a little bit of that later on what that means when we come up with this funding policy to pre-fund those assets. So currently, actually a week or so ago, a new funding policy was adopted. And why did, we want to look at that every once in a while, because as things change over time, there might be a need to change the funding policy. So what did change? Well, the change is pretty significant, is that the plan became in surplus position, meaning assets exceeded liability. So you kind of have to sit back and say, well, is it important then to keep funding at the same rate that we were funding before? So that's why we want to relook at the policy, see what it is we possibly could do different now that the plan is in surplus. And so we did tweak that a little bit. So what is the funding policy? The funding policy is made up of a couple pieces. It's a normal cost component of an actuarial valuations funding method. The normal cost, that is the value of the benefit earned by active employees in the current year. So you can say for every active employee who's not yet retired, every day they work, they're earning more benefit, right? So we want to kind of keep up. We want to pay that normal cost for all of the active employees in the current year. Retirees, on the other hand, do not have a normal cost. They are no longer accruing any more benefits. They have fully accrued their benefit. They are now the beneficiaries of the system. They are, they're getting paid. So we got a normal cost component and then an amortization. What do we need an amortization payment for? Well, on the first day we measured this liability many years ago, there was a liability because you likely had retirees then, and you also had active employees who had more than a month of service. So a liability emerged on day one, and you likely had no assets set aside. So there's what's called an unfunded actuarial accrued liability. As you pre-funded, the assets increased, the unfunded decreased, but you still always had an unfunded liability. So we want to set up some payment method to pay off that unfunded liability. With every valuation that we do, we relook at that because we've got new assets, we might have had some gains, some losses. So we're always kind of resetting the funding policy and how we apply that to the actual numbers that will be used to make those annual contributions. So what happens when we went into surplus? Well, surplus is basically a negative unfunded liability. So we said, sound actuarial funding is that you don't take advantage of your surplus right off the bat. Okay, so you're slightly in surplus. You're not exceedingly, in surplus. So we want to just say, you know what, pay the normal cost. Let's sit on the surplus for a little bit. The surplus could easily wipe away with a market change or a market downside. So we're going to just say we'll pay the normal cost, and then we're going to say no offset for the surplus. That's what the revised funding policy states. And it also gives some outs. It says if we become in surplus at some higher level, say like 130%, we're going to go back and we're going to relook at that funding policy again. Okay, Tracy? So what is our actuarial model? We got this little schematic. We put a little recipe together and put all the ingredients in a bowl, and we mix it all up again, throw it in the oven, and out comes some actuarial results. So what are those, what are those pieces of the recipe that we need? Well, the most important piece really is the employee and retiree data. And we rely on Tracy and HR folks and everybody to provide that information to us, all the retirees who are currently beneficiaries of this program, and then all of the employees who potentially will be a beneficiary of the program. We are collecting information such as date of birth, date of hire, gender, all of those kinds of things, what program the retirees are currently covered under, and that type of stuff. The benefit provisions, what are those? What is it that you're providing? What type of program is the UMS OPEB benefits, right? So it's Aetna Medicare Advantage plan coverage. It's some active plan coverages under Cigna plans. It is the new retiree exchange program. So we need to understand all of the nuances of those benefit provisions. The GASB calls it the substantive plan. It's that, what do the retirees and your employees understand the benefits to be? Because these are not generally as formal as, say, a pension plan that has a plan document. OPEBs tend to not be so specific, but maybe a series of policies that are provided, and make sure that we understand all of them and put that into our cookbook. We select actual assumptions and run them by UMS. So things like the discount rate is the most important assumption that we select. Healthcare trend rates, how do we believe health costs are going to increase into the future? What about demographics? What are these employees going to do? Are they even going to make it to retirement? You could leave and not perhaps have any benefit. And another important assumption, mortality rates. How long, once you are retired, will you be covered under this program? So all those assumptions, and again, we review them at each year that we do this valuation to make sure that they remain reasonable. And then we, as I said, kind of mix them all up and put them in the model, and out come lots of numbers and results that are used for that funding policy I talked about, and then the accounting disclosures. So the plan provisions, I alluded to them, Medicare eligible retirees and spouses could be covered under an Aetna Medicare Advantage plan. Some of those are shared between UMS and retirees. Others are 100% paid by UMS, depending on when they retired. Effective this past January, UMS offered coverage under the Retiree Health Exchange. And that kind of works like the old FSA plans where you were giving so much money to purchase health coverage, to purchase glasses, or things that might not be covered under your health insurance, or perhaps deductibles and copays. With that was a catastrophic prescription drug coverage as well. Anyone who had greater than $1,500 of prescription out-of-pocket costs within a calendar year would be covered under this prescription drug coverage to help offset some of those expenses. Early retirees who are not eligible for Medicare need to be offered coverage as well. So they get offered the plans that are available to the active employees. And so and that's usually a pretty small group of retirees that go out before age 65. And all these details of all the plans are, about 5 or 6 pages in our summary of plan provisions. Our assumptions, what do we need assumptions for? We're trying to predict the future. We're trying to project what we think this program is going to pay out over time till literally the last person dies. So we've got, 22-year-old new hires who are in our model, who are being, we project what we expect to pay out for them. Well, their expectation probably isn't going to happen until maybe age 60 or 65. So we need to get all those benefit payments projected in the future and discount them back to the present. How do we we need to come up with an assumption for that interest rate. So that interest rate discounting factor is currently 7.25. That has been the subject of much debate in the actuarial community on that assumption alone. We were higher than that several years ago, and we've kind of slowly started ratcheting it down. The market has a lot of volatility, and so we have to consider that. We know that year over year, you're not going to earn 7.25, but this is our long-term expectation that on average, the trust will return that amount. As you remember, our results this past year, we had a 27% increase. So what does that do? Or a rate of return? That just creates actuarial gains to the system that may or may not be amortized over the future. So that's an important assumption. We work directly with the investment consultants who, they're the ones who have the portfolio and are making those decisions on, and with UMS on the whole investment policy of this trust, and what do they think long-term the trust will return. And that's your 7.25. Next most important assumption, the healthcare trend rates. And that is year over year, how do we anticipate that costs are going to increase. The benefit payments paid today, all things being equal, we're going to assume the ones that are going to be paid next year are going to be higher. And that generally is the case. Of course, some years might be better than others where you don't get the large increases, and other years there may be greater increases. This is one of the most difficult assumptions to really nail down, only because some of the healthcare stuff is quite volatile. And as I already mentioned, demographic assumptions, things like mortality rates, mortality improvement. We believe that younger generations are going to have greater, let's call it better mortality rates, meaning lower ones in the future than the current cohort. So we look at mortality on a cohort by cohort basis. Basically, every year of birth is looked at as a separate group in terms of their life expectancy. Pre-retirement decrements, it's those things like when you're going to retire, when you're going to perhaps become disabled, when you might leave. So those decrements are important so that we can, not everyone is going to 100% chance of retiring at 65. So we need to look at those contingencies as well. And then once you retire, what's the probability you actually might elect coverage? And then if you do elect coverage, that you'd actually cover a covered spouse. So there's all those things that we kind of have to look at. With the current retirees, we kind of know all this stuff. This is really the assumptions that apply to our active employee group, because we don't know what they're going to do once they retire. So we have this big, as I mentioned, you put it all in the oven, you push the button, out comes some results. What do we do with that? Financial statements hold a lot of this information on a number of pages, I believe. They're usually, quite a few disclosures that need to be put in the financial statements. This net OPEB liability, that's usually total OPEB liability minus assets, goes on the balance sheet, but for UMS in this year, it's actually an asset. FYI, that's pretty unusual situation in OPEB. OPEB is kind of like a new child in terms of liabilities on the balance sheet. And oh boy, we better start doing something about this. UMS really took that initiative much sooner than I'd say every one of my other clients. They're usually, to have an asset is pretty unusual. And also to have as a robust of an OPEB trust as you have is also pretty unusual. There's only like one other state in the union, I believe, that has some reasonable OPEB funding, and that's Ohio. But otherwise, not a whole lot of effort has been made over as long as a period as UMS has. We also calculate some expense numbers, and again, this year, because we had a change in the liability that was a negative, it was a reduction of the liability due to the retiree exchange program. We have an income calculated for this fiscal year, and that's about $46 million. So what do we do? Our expense is basically, how does the OPEB liability change year over, from the beginning of the year to the other year? The accountants under GASB allow us to defer a few of those things that are a little bit more volatile: experience gains and losses, assumption changes, or investment gains and losses. What they make you recognize immediately are benefit changes. And the theory is that those are under the control of the plan sponsor. So you're taking, steps to make those changes, then you should need to recognize them immediately. We do a 5-year projection of our expense/income. And so for over the next 3 years, we're expecting income still of about $3 to $4 million. And then in 2026, it will flip around and turn to an expense of about $4 million, which generally is a little bit close to the normal cost, because that's all that's left. You're fully funded. You've taken care of all of those things. You've deferred recognized all the deferrals, and you should land pretty much at your normal cost for your expense. So our valuation report, I don't know, it's about 40 pages long, probably. It has all of this information in, of course, greater detail. The GASB also has some pretty good, they're there for the benefit of the public. So they have some very good information on, what is OPEB and what is this thing all about, and what does it mean to public entity employers and their financial statements. And let's put out my contact information. If anybody had any questions, we're happy to clarify anything or answer anything.
Any committee members have questions of Linda? That was an extremely comprehensive presentation. Mike?
Yeah, just a quick question. Have you ever done any assumptions, say, assuming that, say, if Congress lowers the age to be eligible for Medicare, one of the reasons why some people stay until they're 65 is because of healthcare, but they lower it 5 years to age 60. Have you ever done any assumptions of what that might do for the pension, since some people might be retiring as soon as they can get on Medicare?
We haven't specifically studied that, but it would absolutely, if that materialized, that would be a huge impact on many OPEB programs. Not only the benefits themselves, I mean, the whole plan structure would change, but also assumptions on, and then we, I think, as you mentioned, would see a shift in, people, when are they retiring? Are they holding on to get that Medicare eligibility date under their belt and then retire? So that is definitely something that would hugely impact OPEB programs, any kind of Medicare. I mean, that is the key to programs. We work with some entities where they don't require their retirees to go on to, say, a Medicare supplemental plan at 65. So the retiree is happily staying on, a full like HMO. Those, when we value them out into the future, are hugely expensive to hold on to. So the theory is, let Medicare be first provider and have your plan be secondary, so that you do see, and I always do this, like at 65, it drops, the claims curve drops because Medicare is primary. So yeah, that excellent question. That would be something that would need to be studied in quite detail.
Okay. Thank you.
Other questions from committee members? Any other trustees have questions? Tracy, Ryan, any comments that you need to make?
I want to thank Linda for being with us today and doing such a great job reviewing this usually very difficult topic to understand. Appreciate being here.
Thank you very much indeed. That was a very good presentation.
Thank you very much. And I had this in my head, and of course, because I didn't write it down, I forgot to mention it, but I did want to talk about Tracy and her entire staff. And I can see some folks here, I know that they are probably our toughest group that we work with in terms of getting us really good information, very thorough. It's unusual. We've got to come back. We've got a big long list, right, Janice, at the beginning of the process, and they are very punctual with things. They, so I have to say, shout out to the group for making our job easier when we're trying to, get what is a pretty large project in front of them when they need it.
Thank you. Thank you for that feedback. So the next item we have is the annual financial report, and Tracy and Darla are going to present that.
Thank you, Chair McMahon. And if you bear with me just a moment as I share my screen. So hopefully you can see the PowerPoint presentation. And so good afternoon, everyone. And I'm pleased to present to you today.
PowerPoint's not up, Darla. Oh, there you go.
Oh, okay. I'm pleased to present to you today the university's annual financial report for the year ended June 30, 2021, which is located in your materials at tab 4.1. I will, however, be speaking today from the PowerPoint in tab 4.2. I would note that this 110-page report is still in draft form, and it's awaiting board approval later this afternoon. And before I get started with the actual presentation, I'd like to express my appreciation to our auditors, to all of the campus and system personnel who responded to our many, many audit requests so that we were able to timely complete these statements. And I also want to thank my entire staff for their efforts in getting us to this point. There's a lot of time and energy spent on closing the books at year end, going through the audit process and preparing the financial statements. But I especially want to thank Janice Elsmore, the Assistant Director of Accounting, who leads the audit for the system and who prepared the bulk of the financial statements that I'll be presenting today. So Janice, thank you very much. Terrific job as always. Thank you. So moving to page 2 of the PowerPoint, you see here some of the discussion topics for today. Now, some of these I'm just going to touch on ever so briefly so that hopefully we can spend most of our time on pages 7 through 12, which cover the system's FY21 financial results and financial position. Now, if you looked at the table of contents for the annual report, you'd see that the report is actually quite comprehensive. As I mentioned, it's 110 pages long, has a lot of disclosures related to the OPEB plan that Linda just presented. And the report consists of several sections. Today, however, I'll be addressing 2 of those sections, the auditor's opinion and select financial statements from the financial statements section. And as you can see on page 3 of the PowerPoint, there are actually 3 different sets of financial statements included in the annual report, and all of these sets are required. Today, however, I'll be focused on the ones that are in the system-wide column. And those financial statements include the system's assets, liabilities, deferred inflows and outflows of resources, net position, revenues, expenses, and cash flows. Now, the set in the middle covers the financial position and financial activity of the systems component unit, the University of Maine Foundation. And finally, in the third column, we see a new set of statements. These are new for FY21, pursuant to a new accounting standard, GASB 84 on fiduciary activities. And these statements include information about assets that the system holds for other entities in a trustee or fiduciary capacity. And I'll note that in prior years, some of the assets that you'll see in the fiduciary statements were actually reported in the system statement of net position, and there was an offsetting liability so that the system didn't recognize any net position associated with them. But those are now moved out of our statement of net position and over to the fiduciary activities statements. And for comparability, we did restate the system's FY20 statement of net position to remove those fiduciary assets. Now moving to page 4, and before we jump into a discussion of the financial statements themselves, I want to address the independent auditor's report here on page 4. And as you can see on this page, unlike prior years, this year I've presented a scenario 2 under which there's a disclaimer of opinion related to the systems component unit, the University of Maine Foundation. I want to assure you, however, that the illustrated disclaimer relates to a manpower issue faced by the foundation's auditors this year and doesn't have anything to do with what the foundation staff has or has not done. Actually, foundation staff have already prepared a draft of their financial statements. They provided that draft to us and they provided it to their auditors. And at this point, they're simply awaiting completion of their audit. To give you a little more background on this situation and why I've included it in the slide. In mid-August, the foundation notified us that their auditors were experiencing the manpower issue this year and wouldn't be able to complete their audit in time for the system to submit its final board-approved financial statements to the state of Maine. As you may recall, and the reason why we have the special board meeting this afternoon is that the state of Maine wants us to submit our final financial statements to them by November 1st. So once I heard about this issue, I worked with our auditors, the state of Maine Controller's Office, and the foundation to determine what the impact of the delay would be and to find an acceptable resolution. We collectively reached an agreement that the foundation's auditors would provide us with their audit opinion by mid-November so that our auditors can then complete the systems audit and we can provide the state with our final financial statements by the end of November. Now, the opinions that are listed on this page under scenario 1 and also included in the annual report draft in tab 4.1 are based on the assumption that all will go according to this revised plan and the opinion for each reporting unit will be unmodified, or what we call a clean opinion. And at this point, we have no reason to think that the modified deadlines won't be met as the foundation's audit is actually underway. Now, historically, when we presented the system's annual report to you and the board has approved the report, the foundation's audit has already been completed. Thus, we know what the auditor's opinions will be. Because that's not the situation this year, we felt that it was prudent to share with you what the auditor's opinions would be this year if there was another unexpected delay and the system needed to issue its financial statements prior to the foundation's audit being completed. Those opinions you'll see are under scenario 2 and include a disclaimer of opinion related to the foundation's FY21 financial statements. They don't apply to the FY20 data, just FY21. And as noted in the paragraphs at the bottom of page 4, a disclaimer of opinion means that the systems auditors have been unable to obtain sufficient appropriate audit evidence on which to base an opinion. And basically that audit evidence is usually the audit report of the foundation's auditor. I also want to assure you that neither the system nor the state of Maine want to issue statements with a disclaimer of opinion. However, both entities do have compliance-related deadlines for issuance of their financial statements. For example, part of the system's debt covenants are that we issue our financial statements within 180 days after year end. So if another delay in the foundation's audit was to occur, the system could be forced to issue its financial statements with unaudited information included for the foundation, thereby requiring the need for a disclaimer. I will point out that there's, as I mentioned, the foundation's audit is underway. And the other piece of good news is that at their board meeting earlier this month, the foundation's board approved moving the foundation's fiscal year end from June to December, so that we won't be encountering this issue. Historically, they have met our deadline, but they have struggled to do it. So this will kind of provide some relief and help us to avoid this year's situation. So in wrapping up this area about the independent auditor's report, I'll just restate 2 things. First, the current delay with the foundation's audit is due to a manpower issue faced by their auditors. And second, at this point in time, we expect to have the foundation's audited financial statements in hand by mid-November so that the system can complete its own audit and issue its statements to the state of Maine by the end of November. So I'll move now to a discussion of the financial statements. And on page 5, I tried to bring some color to the presentation, but we have a visual of the key factors that you might hear me mention during my discussion of the financial statements. As can be seen from this slide, FY21 was a mixture of neutral factors, good factors, and bad factors, with the good collectively outweighing the bad from a purely financial perspective, enabling the system's financial position to increase by nearly $113 million. I'd caution or note, however, that the good factors that enabled this increase are not necessarily ongoing. So for example, investment returns can fluctuate greatly from one year to the next. Granted, it's not a revenue item necessarily for the financial statements, but as Linda mentioned, the investments in the trust went up 27% for FY21. And the factor that she uses is only 7.5 or 7.25. So these big swings in the investment markets can happen. And although coronavirus relief funding has certainly helped with the additional costs and lost revenues from the pandemic, they did not cover all costs and losses, and those funds will eventually end. And unless something new is enacted, they'll be ending in FY22. And the significant savings we'll discuss in just a moment related to this year's OPEB, change in the OPEB plan are not ongoing at the FY21 level. Linda's presentation had noted the $46 million of income this year, a little bit of income for the next 3 or 4 years, and then eventually about 5 years out, it switches over to an OPEB expense item again. So on slide 6, I just wanted to give you a visual of the OPEB plan. It's a very significant item for the financial statements. And with, for FY21 in particular, it has a very significant impact, and it impacts a lot of lines. So I just figured I would give you a summary so that you could see some of the variances from the statement of net position and from the statements of revenues, expenses, and changes in net position, and see how much of that variance was actually attributable to the OPEB plan. So just looking quickly under assets, you see the $18 million net OPEB asset. That's new for this year. Normally, under non-current accrued liabilities, we'd have an OPEB liability. However, this year's the asset, so we have the $76 million swing in accrued liabilities. And then with the impact, the $46 million noted for the increase in net position attributable to the OPEB trust, the OPEB plan, as the system recognized $46 million of OPEB income for FY21. Historically, the system has experienced OPEB expense. So this same OPEB income for FY21 impacts the institutional support expense line in the statements of revenues, expenses, and changes in net position. In FY20, as I mentioned, historically, there's an expense, and in FY20, it was $9.5 million, compared with the $46 million of income this year for a swing in institutional support costs of nearly $56 million. The final thing that I'd note about this page for the accountants in the room is that, because I know you'll try and add up the OPEB variance column and it does not net to zero. That's because I did not include the impact that the OPEB plan has on cash. And so we actually used $12.5 million of cash related to the OPEB plan as the system paid retiree health costs and made contributions to the OPEB trust. So with that, I'll move to the statements of revenues, expenses, and changes in net position, what we fondly call the SHRECNIP. And as required by accounting standards, we've presented the system's revenues and expenses by 4 categories: the operating revenues versus operating expenses, the combined group of non-operating revenues and expenses, and then other changes in net position. Now on this page, we see the operating revenues of $405 million, less operating expenses of 679, hopefully I said million the first time, 405 million, less operating expenses of 679 million, for a resulting operating loss of $274 million for FY21. Now, although we've not measured the exact dollar impact of the pandemic on each of the lines in the SHREC-NIP, we do know that the pandemic played a major part in the following lines from the operating revenue section: the $12 million decrease in residence and dining fees, the $10 million decrease in educational sales and services and other revenues, and the $4 million decrease in other auxiliary enterprise revenue. Now, the impact of the pandemic on operating expenses would be mixed. The system would have incurred certain costs that were specific to addressing the pandemic in order to keep staff and students safe and to support struggling students. But on the flip side, the system also avoided certain other costs as a result of certain activities being curtailed. And I'll point out just quickly under the operating section, you see again the institutional support line, which decreased $52 million. And this is primarily related to the OPEB change I mentioned a moment ago. Now moving to the very bottom of this page, again, the operating loss. I'd note that the system's operating expenses are always going to exceed operating revenues, as GASB, who sets the accounting standards, requires several revenues that the system uses to fund operations to be reported as non-operating. And we'll see those revenues later on page 9. Moving quickly to page 8, this is just another way of looking at operating expenses on a natural classification. And again, we see the impact of OPEB on the benefits line. At the top of page 9, we again start with that same operating loss of $274 million. And under the non-operating revenue section, we see all of those revenue streams that are crucial to supporting the system's operations, but that we can't report as operating. And so if you apply those to the operating loss, the system actually ended FY21 with income before other changes in net position of $59 million, up from the $106,000 for FY20. And I'll quickly just note 2 lines under the non-operating. The first is the coronavirus relief funding line, which is up $20 million from FY20. The FY21 total includes both federal funding received directly by the system from the U.S. Department of Education and referred to as HERF dollars, and also some federal funding passed through the state of Maine for testing and personal protective equipment. Since the pandemic began, the systems received 3 rounds of federal HERF dollars for a total awards of just under $104 million. And each round has involved awards specifically for student emergency aid and awards for institutional need. And as was the case in FY20, with monies received under the CARES Act, or what we reference as HERF-1, revenue recognition in FY20 for HERF-2 and HERF-3 institutional awards were limited based upon what percentage of the student awards have been spent. So as an example, the system applied $17 million of lost FY21 revenues against the HERF-3 award. However, it can't recognize that $17 million until FY22, when the system spends the HERF-3 student awards through making awards to the students. The other line I would note just quickly is the investment income. It's up $22 million from the prior year. Current year returns were 7.7% compared with 3.8% for the prior year. Again, investment income is one of those revenue lines that can fluctuate significantly from year to year, depending on markets. And the FY21 return of 22 million is actually 10 million more than the second highest return experienced in the past 5 years. And that second highest return was back in FY19. So remaining briefly on this page, if we look at other changes in net position, we see that they total 54 million, which represents an increase of 40 million from the prior year. Again, revenues in this section also tend to fluctuate significantly from year to year. And revenues in this section also, rather than supporting the day-to-day operations, they support additions to capital assets and endowments and the reduction of debt, items that are all on the statements of net position. And I would just point out endowment return, again, good market returns for FY21. And the biggest thing I want to note about endowment returns are that they're actually reported across 2 lines in the SHREC-NIP. Endowment return used for operations, which is part of the non-operating revenue section, and endowment return net of amount used for operations, which is shown here under other changes. And the combination of these 2 lines was a positive 35.4 million for FY21 compared with a positive 1.4 million for FY20. So if we move to the close to the bottom of the SHREC-NIP, we see this line change in net position, which was $112.6 million for FY21. And this change in net position carries over to the statement of net position, to which I will now turn. And I'm actually going to skip a slide for the moment and move to page 11. And if you look at the total net position line, you see the $112.6 million that you just saw at the bottom of the SHREC-NIP. So as you can see, there are 4 different categories of net position. I just want to take a moment and touch upon a few items related to unrestricted net position, which basically is net position that doesn't fit in any of the previous 3 categories. And at $182 million at June 30, 2021, unrestricted net position has for the first time reached and surpassed its pre-GASB 75 June 30, 2017 balance of 171 million. Earlier in the FFT meeting, Tracy had commented on the impact that adopting GASB 75 had on unrestricted net position when we adopted it. And so GASB 75 had brought the entire OPEB liability into the system's financial statements and caused the June 30, 2017 unrestricted net position balance to decrease from the originally stated $171 million down to $82 million. And with regard to the $79 million increase in unrestricted net position for this year, the system's OPEB plan accounts for 46 million of the increase. Actual investment income in excess of what we budgeted accounts for 19 million, leaving 14 million generated from various other unrestricted activities. And the final point I'd make on unrestricted net position is that it's not subject to externally imposed stipulations. However, these resources are critical for the financial stability of the system and have been designated by management for specific areas that are noted on page 12. I'm not going to turn to page 12, but would certainly entertain questions at the end of the presentation. Now moving briefly back, moving back to page 10. I'll just quickly note something on assets. So looking at the assets section, I'd note that the system had good and improved liquidity with $289 million in cash and operating investments. And these two items combined actually account for 78% of total current assets. Looking quickly at non-current assets, you can see they totaled $940 million at the end of this year. And I just want to point out a couple of lines. First is the deposits with bond trustees, which increased 28 million. This increase is related to the $43 million of bond anticipation notes that the system issued this past May and represents a portion of those notes that hadn't been spent on projects as of June 30th. In this section, again, you can also see the new net OPEB asset of 18 million. And with the $32 million increase in endowment investments, again, this is primarily the result of the investment returns noted a few minutes ago. I would restate here that we did restate the FY20 amount for this line to pursuant to the system's adoption of the new accounting standard, GASB 84. Historically, this line included pooled endowments for some of our affiliated entities, one of them being the USM Foundation. And again, those balances for FY20 were moved out of this statement of net position and moved over to the statements of fiduciary net position, which we will discuss momentarily. Now, going back again to page 11, which it looks like I already did, we'll now look at total liabilities of $324 million, and these are down 8%. Again, I'll just note this $78 million decrease in accrued liabilities. Again, that's related to the OPEB plan. And the second variance I want to note is the $29 million in non-current long-term debt. Again, this line was impacted by those bond anticipation notes that the system issued in May, less what we repaid on previously issued bonds, notes, and lease purchase agreements to arrive at that change of 29 million. Okay, so we've already discussed net position, so we can leave page 11. And so that brings us to slides 13 and 14, where you see the new required financial statements for the system's fiduciary funds. They include both certain assets that were previously included in the system's statement of net position and certain other assets that were not previously included in the financials at all. So examples of assets previously reported in the SNP include cash held for student government groups and those endowment investments held for some of our affiliated organizations. Assets that were not previously included in the SNP or statement of net position include investments held for other third parties, such as the separately held investments for the system's defined benefit plan and the UMS managed investment pool funds held for the OPEB Trust, for Maine Maritime Academy, and the University of Maine School of Law Foundation. And then, of course, on page 14, it just shows how, the changes that happened in those fiduciary assets during the course of the year. And with that, that brings us to the end of the presentation, and I would be happy to answer any questions you may have.
Thank you, Darla. That is very comprehensive. Questions?
Maybe not a question as much as I'd just like to understand your thoughts. And I know while you were presenting this budget information, I'm just curious to how much CARES Act and the strong investment returns have really led to such a better budget than previous years. If you'd like to speak to that.
Well, with investment returns, the system does budget investment, an investment return related to its operating investments. That's, I will call it a conservative amount, so that we make sure that we haven't budgeted more than what is likely to be available to support current year operations. And then typically the practice is at the end of the year, if those investment returns are higher than budget, we will either move it into the budget stabilization fund, or they may fund special initiatives, special projects of the board or management. So we take a relatively conservative approach to budgeting it and setting our expense budget for the year, and then have a strategic plan for using whatever returns exceed that budget. And with the CARES Act monies, or the HERF monies, those aren't necessarily part of the E&G budget, but we applied a lot of those dollars towards FY21 lost revenues. So part of the uses that the federal government, or the federal rules and regs allowed was, we knew the pandemic had an impact on our revenue stream. So either students weren't coming to campus to stay in the dorms, or we had to limit the number to keep everyone safe. So we were able, through a process, to average what our revenues were for the 3 years prior to the pandemic hitting, applying an increase to it, coming up with what an estimate, and the federal government recognizes that as an estimate, and comparing that with what we actually experienced, and then claiming the HERF dollars for that difference. With some of the campuses, they spent like all of their HERF 2 and 3 funds on those lost revenues, while others still have HERF monies available for maybe an HVAC project or other initiatives for FY22. Did that answer your question?
Yeah, so we had some flexibility in terms of where we allocated it. And then one final question I have, I won't monopolize all your time, is just early on in the presentation, there was a 4 million decrease in auxiliary enterprises. And I'm just curious what maybe that is.
So one example is the one of USM's auxiliary enterprises is the transportation. Well, actually, you were talking about on the revenue side or the expense side?
I believe there's a reduction in revenue.
Yes, so the other auxiliary, one example of that at USM are the transportation fees that they charge to the students for, busing them between campuses, and parking fees for being able to park on campus. So because the volume of students and staff on campus was less, they had a reduction in revenue related to that. And that was actually significant enough for USM that they cleaned that against some of their HERF dollars. So primarily it's been room and board that we applied to the HERF dollars, a little bit of tuition and fees for some campuses, and then again, the example for USM of other auxiliary. But by far, room and board is the biggest loss revenue that's been claimed.
Darla, could I expand upon that? Because I asked that question to myself yesterday, why the auxiliary revenue went down so much. So I went back and looked at our analytics of that account, and which Liz Perry did a phenomenal job in outlining and summarizing where the changes were. And they were pretty much split between athletics and dining services, dining sales and services, almost half and half. One of the bigger ones for athletics was a $1.2 million Pepsi pouring rights between Orono and Southern Maine. That was the single most largest reduction in revenue. And they also had, for the athletics, they held no summer camps, sporting tickets. Nobody was allowed to go to any games. And I believe a lot of people still maybe purchased their season tickets, hoping for a better year. And facility rentals, ice rentals, hockey ice rentals were down on both USM and UMaine. Substantial, over $400,000 for USM. And then for the dining area, obviously there were no meetings going on, so they lost a lot of sales, services, and facility rentals.
Right, so those
That
are all,
accounted for.
yeah, those are all lines for the educational sales and services. Yep.
I'm
Which did go
sorry for
down $10
interrupting.
million.
Sorry for interrupting there.
I think that's enough narrative. Yeah, thank you for the response. I appreciate it.
Other questions, concerns?
I've got a question, Chair McMahon. Darla, earlier thank you, by the way. I'm always in awe at this annual meeting when I come here, that all the presenters and do such a good job of explaining stuff that can be very complicated. They basically summarizing, highlighting, we walk away with a much better understanding. So thank you for all you're doing. Something that is a little bit alarming, and I'm wondering, and I know it alarms you as well, but the whole thing with auditors coming back on the 11th hour and saying we may not be able to get this done before November 2021, and we really need to have those in to the state before that, or should have it in there before that. Is there any consideration of maybe saying, well, you know what, thank you for your services, but we need to move on with another auditor because we need to rely on you. This could have grave consequences. And my understanding, that's the foundation, correct?
Yes, and they have a separate set of auditors than what the system has. Mm-hmm. And the foundation CFO did reach out to a couple of other firms in the area when he found out that there was going to be a delay, just to see if somebody else could pick them up this year and get the audit done. I think staffing issues, probably Sarah and Mike Johns from CLA could kind of talk about the environment in the public accounting, the workforce environment in that arena. But the other two firms that he contacted, they couldn't commit either. And of course, if you're a brand new auditor, there's a whole list of things and procedures and everything that you have to go through, including communication with the former auditors. I have to admit that the state controller's office wasn't overly happy about the delay, but they did determine that if we had a disclaimer or a modified opinion, that it would probably force them to have one as well. So, there was some wiggle room, and the agreement we came to is that we should be able to provide them with our final financial statements by the end of November. And as I mentioned, the foundation has since voted to change their fiscal year end to December. One of the things we have to work through with our auditors is what does that mean for FY22 itself, because I'm assuming that we'll need 12 months worth of financial activity for the foundation to put into our FY22 financial statement. So we could use calendar year 21. So there may be a re-audit of the first 6 months of calendar 21. That's something that we still need to discuss with our auditors and with the foundation's auditors. But hopefully should have their audit in plenty of time next year. If we can't, then there is really an issue.
Thanks for your response.
Other questions? Obviously, this delayed audit from the foundation is an important factor, and we have a resolution which I'll read, and then we can certainly take questions if there are questions on the resolution. The resolution is that the Board of Trustees accepts the recommendation of the Audit Committee and approves the FY 2021 Annual Financial Report as presented, except that should the University of Maine Foundation's audit fail to be completed prior to UMS issuing its annual financial report, a disclaimer of opinion would replace the unmodified opinion regarding the Foundation's FY 21 financial statements, which are included in these draft statements. So the motion is asking us to vote on these financial reports with the possibility, if the Foundation's audit isn't completed, that there will be a disclaimer of opinion. Are there any questions on that proposed resolution?
Chair, can I make one more comment?
Absolutely.
Just to assure the committee that, so I was last in contact with the foundation last week, but my plan is to actually be reaching out to them on a weekly basis to see where they're at, just to make sure that things are going along, and that they will be providing the data that they agreed to provide by mid-November, so that we don't get to mid-November and surprise, it's not ready. So I will be checking in on a regular basis.
Thank you. So I'm looking for somebody to propose the motion and a second for the motion.
So moved.
Second.
Sorry, proposed by Mike, seconded by Jim Irwin. Is there any further discussion on the motion? Kelly?
Chair, I do have a question. Does that mean that we need to have another special board meeting for final approval after the foundation's audit is included, when it's completed?
Ryan or Tracy O'Dalla?
I was just gonna say, it's not the intention that you would need a special board meeting, which is why we structured the resolution in this way. There's really two ways this is gonna go, where all of the opinion units will have an unmodified opinion, or all except for the fiscal 21 for the foundation. So we presented the two options, and our recommendation would be that you approve, and certainly we can send a note out to let you know. But if you're feeling you need a special board meeting, that's within your purview.
Any other questions? If not, Alan, could you call roll, please?
Certainly. Trustee Bartholomew,
Yes.
trustee Donnelly,
Yes.
trustee Irwin,
Yes.
trustee Gardner,
Yes.
trustee McMahon,
Yes.
trustee Martin,
Yes?
trustee Mishu.
Yes.
The motion is carried.
Thank you. And the next item on the agenda is the auditor communication, the audit committee, Michael Johns and Sarah Doria. I see they're there. I don't see them, but they're on the screen. Michael there as well.
I'm here.
Good afternoon, Michael.
Good afternoon, Mr. Chairman.
The floor is yours.
Thank you for having us. Tracy, will you be doing my PowerPoint, or should I share my screen for that one?
If you could share yours, that'd be great.
Okay. Hold on here.
You want me to do it?
Can everyone see a PowerPoint presentation? Okay, great. Well, thank you for having us. My name is Michael Johns. I'm the engagement principal from CLA. I know I've met many of you, if not all of you, previously, but thank you for having us. I'm joined today by Sarah Doyle, who is the engagement director on the audit for fiscal year 21. And the two of us are going to go through some required communications and other topics, and be glad to take any questions you may have. We're going to go through the audit process. We briefly spoke in the spring about what we were planning to do. So we're going to circle back and communicate how the process went, a very high level of what procedures we performed and the results of those procedures. And Darla stole a little bit of our thunder and showing you what the audit opinion is going to look like, but that's usually the result of our work, is the expression of opinion on the system's financial statements. We're going to go through some required communications that our auditing standards make sure that we discuss with this group. And finally, just next steps in concluding the engagement this year, given the revised timeline, although I think management covered that pretty well. So I'm going to turn the next slide over to Sarah, and she's going to talk a little bit about the process itself. Sarah?
Thanks, Mike, and good afternoon, everybody. For those of you that I haven't met, as Mike said, my name's Sarah Doyle. I was the engagement director on UMS this year. And we're going to talk through the audit process. So before we go through the results, thought it might make sense to just revisit that discussion that we had back in May at the kickoff of the process. So we take a risk-based approach when we're doing the audit. And what that means is that we design our audit procedures and focus our time on areas where there's a greater risk of material misstatement to UMS's financial statements. So each year we go through a risk assessment process to determine those areas, and we factor in such things as economic factors, industry circumstances, or just areas that are inherently risky by their nature. Really the start or the foundation of that process is the internal controls that are in place, and gaining an understanding and building on that understanding and getting our arms around any changes that may have occurred in that process during the year. And then we use that understanding to design our audit procedures. So part of that gaining the understanding process is doing walkthroughs of transactions and also testing controls over key cycles to make sure that those key controls are in place and operating effectively. So on this slide, here, you kind of see a pie with a lot of pieces going into the pie that's outlining what those higher risk areas are. I'll preface this with, just because you don't see something listed here doesn't mean we totally ignored it and did nothing on it. You know, these are just those higher risk, or the bigger areas where we spend a larger amount of our time on the engagement. I'm not going to go through each one of these in detail, but I thought maybe to highlight some of the larger areas to just talk through some of those procedures that we performed this year. So the first is the fair value of investments, and I'll lump in the related investments returns there. So I think we've hit on a little bit already about the investment returns and the market this year. We're looking at those returns analytically as well, based off benchmarks and the performance of those benchmarks versus the funds. But really the major assertions here that we're looking at are the existence and the valuation of those investment holdings. And we test that by confirming the investments directly with third parties. And then we look at valuation sort of in two different buckets. We kind of break out the population into those investments that are easy to value, readily determinable. You could go on the Wall Street Journal and find their value. And then those that aren't actively traded, which are those investments that are recorded at NAV, net asset value per share. So in order to test those, we send a confirm to those fund managers and request the ownership percentage that UMS holds. We also get the audited financial statements for those funds, and we calculate what UMS's share of that fund's net assets is, and roll that forward to the June 30 year end based off the activity for the year, and compare that to what's been recorded by management on the general ledger to make sure that those estimates are reasonable. We had no exceptions in our testing, and found that everything looked to be reasonable this year. Another large area is revenue and related receivables. So under generally accepted auditing standards, which we have to follow, there's a presumed risk of revenue recognition on any audit. And our responsibility as auditors is that we have to build an audit plan to make sure that we're adequately addressing that risk, making sure that those revenues are accurately reported, but also reported in the proper periods. So there's obviously a lot of different revenue streams. I'm not going to bore you guys and go through every revenue stream and every procedure we do, but really the three largest, tuition, room, and board, we do a recalculation of those revenues each year. We get a census, for tuition and room and board, and calculate it based off the approved rates for the year to compare to what's been recorded on the general ledger. And we also look at any, deferred revenue related to those terms that might straddle fiscal years. Grants and contracts is another significant revenue stream where we do perform a test of controls, making sure that the process in place to ensure that the allowable costs incurred for those grants is operating effectively, as that really is what drives the revenue recognition of the grants. Darla did a great job explaining all of the HERF funding. Obviously management spent a lot of time putting together their analysis, and we spent a significant amount of time, going through that analysis and working through it, together, just to make sure that any financial statement implications as well as single audit implications were thought through. And we'll talk through that a little bit more in detail later in our presentation. And then lastly, state appropriations. We send a confirm to the state of Maine and confirm those amounts directly with them. The last one that I'll just mention here is the pension and the OPEB information. So, there was a great presentation by Linda on the OPEB. I don't think I could even go give it as much justice as she did, but in terms of from an audit perspective, we rely on those specialists when we're performing our procedures and getting those actuarial valuations and looking at the inputs that go into them each year. So a big part of that is the census data that's provided to do those calculations. We test it to make sure that that demographic information is accurate that's going into the calculation, and also look at the significant assumptions that go into the calculation as well. Before I move on to the next slide, Mike, I'll just ask if you have anything that you want to add in terms of the risk assessment for this year.
No, I think you did a great job, Sarah. And we do look at the other estimates that go into those actuarial calculations as well, making sure they're reasonable compared to what we see in industry standard.
So I think we covered a lot of these points, but one of the things that I didn't mention when we talked about internal controls was the IT. So there is an IT component to gaining the understanding of internal controls and looking at the IT environment and the general IT controls as it relates to the financial reporting process. So we're obviously not doing a full-blown IT audit, but we are looking at the general controls that are in place, that would impact the financial reporting process. We use the assistance of an IT specialist at CLA who works with UMS's IT department in order to perform those procedures each year. And we touched on it already about the University of Maine Foundation, that we don't perform any audit procedures on that information, that we rely on the other auditors' information. You can move, thank you. So that's sort of a high level what the audit process was. Now we can kind of go through the results of that process. We didn't have any audit adjustments. No material weaknesses were identified. As Mike mentioned, Darla stole our thunder. Unmodified opinion, that's our best news that we can share. It's the highest level of assurance that we can provide as external auditors. It's another word for a clean opinion. If you could advance to the next slide. We have some required communications that we have to make under our auditing standards. These are highlighted here for you on this slide, but there's also a formal letter that outlines these in more detail. We're kind of reporting back on our original plan now. There were no changes to that original scope that we discussed back in the spring. Darla talked through the adoption of the new standard GASB 84 fiduciary activities and the impact it had from a reporting perspective on your financial statements. Another area we're required to look at under our auditing standards are significant estimates. And why these are important is because anytime there's an estimate, there's judgment involved, and want to make sure that those estimates are reasonable and that there's no bias when applying those estimates. So your more significant estimates are listed out here in the bullet points. And we work with management to gain an understanding of that estimation process and make sure that those methods are reasonable and consistently applied year over year. We also do a look back analysis to see how that estimation process really played out to make sure, again, that those estimates are reasonable as of June 30. The audit was a smooth process. We encountered no difficulties. Management was well prepared, provided us all the information timely, and it really helped to facilitate a smooth audit process. At the conclusion of the engagement, there'll be a customary management representation letter that management provides to us, and that'll obviously hinge upon the completion of the foundation's audit once we get the other auditor's report. So if you could go to the next slide, in terms of next steps, really where we're at as of today, waiting for the foundation's audit to be finalized, and then we'll update our subsequent event procedures through our report date, and get that signed representation letter and be in a position, to move forward.
So a few comments on the completion of the audit process. I agree with the timeline management put out and requiring the foundation to be done and issued on the 15th of November. And the reason for that deadline from our standpoint is management has to incorporate the final numbers into the system's financial statements. We then have to review that, and our file then needs to go through our what we call final quality review process. So generally when we meet at this meeting, that final quality review process has taken place. That process can't take place until everything's done. So we have that 2-week window there for management to update, myself and Sarah to review that information, and then go through our quality review process. And finally, update some subsequent events from the last time we were performing virtual field work. So just wanted to reiterate that it is a little different process this year, but as Darla said, should everyone meet their respective deadlines, issuance by the end of the month would not be an issue. Darla did a great job in going over the financial results for the year, and I think one of the trustees asked some questions about the variances, but just pointing out that with this higher education emergency relief funding within the current year financial statements, there were $29 million recognized in revenue, and there will be some more for next year. And from an audit standpoint, these funds came with provisions that federal grants have never come with before, frankly, in terms of defining things such as lost revenues. Never seen that in a federal grant before. And just the fact that you could go back all the way to March of 20, even though that's not in the current fiscal year of the financial statement. So we did spend significant time in auditing that area and didn't find anything. It will be subject to the federal single audit, which will take place in the winter time frame. But just wanted to point that out, that a lot of new provisions there, and I believe management did a good job of capturing that and complying with the applicable standards thereof. So this slide, I think, was already covered by Darla, so I'll skip the financial analysis of going over some financial highlights there. Looking ahead to next year, we had GASB 84 this year, which required those new fiduciary financial statements. Next year, there's a big standard on leasing activity. Right now, there's 2 accounting treatments for leases. One is called operating leases, and those classifications, generally, we just record expense as we make our lease payments, and a capital lease treatment in which you record an asset and a liability to the lessor. Going forward, when this statement is adopted, all leases will have to go on the statement of net position. So there will be a right to use lease asset and a lease liability due to the lessors. All those operating leases that previously did not require to be recorded on the statement of net position will go on there. What this statement also does is introduces a concept of embedded leases, in that not every agreement that may be a lease says lease at the top of it. There could be service contracts where there is an asset associated with them that will need to be reviewed. The plain vanilla simple example is you think you're paying for a coffee service, but it turns out you have the rights to those coffee machines and you have an embedded lease in that agreement. So there is going to be, unfortunately, some homework to be done by management in adopting this standard, and it is required to be adopted in fiscal year 22. So stay tuned. Just what we wanted to just give the highlight here. I think we discussed it before that this is coming down the pike and could have another significant change in what your financial statements look like at the end of fiscal year 22. So what we recommend for everyone in the adoption of this standard is really taking an inventory of all the agreements we know are leases and taking a look at those service contracts and determining if they contain lease components. So we have a starting point for the analysis, and potentially looking into a software solution to be able to account for these leases. We're generally recommending that any entities even over 10, 15 leases, an Excel spreadsheet probably isn't the best way to account for the leases, just because of their lack of internal controls, where a lease software would have those controls in place to make sure that there can't be an error in the calculations, just assuming that the information is inputted right. So those are the steps that I know are currently being undertaken, and what we recommend that be started and have started. That's really the significant standard for next year. I could give everyone continuing professional education accounting credits by going through this laundry list of new GASBs over various fiscal years, but I don't think it's pertinent information for this group. Really, GASB 87 is the one to keep the eye on right now, and that could impact the financial statements, significantly. In conclusion, it was a very, what I would say, smooth audit process. We were remote again this year, but management was great in working with us and providing electronic information effectively. We did not note any material weaknesses in the internal control structure. We don't express an opinion on internal controls, but when we do identify those significant deficiencies and material weaknesses, we would be required to report them to this group, and we did not note any of those deficiencies. And as the next steps, we will work in November to get the statements issued and on time to meet the state's reporting requirements. Those are really the end of our formal remarks, but we'd be happy to take any questions that the committee has.
Are there any questions from the committee to the auditors?
Chair, I have a question.
Go ahead.
In thinking about the change to...
Sorry, can you take the screen down, Mike, please, so we can see who's talking?
I lost my... I'm trying to do that now.
Go ahead with the question.
It's in regards to the change in lease accounting. I'm just trying to think this through. In the case where we are leasing, let's say, a large facility to a third party, would that come off our books and go onto theirs? And does that change our net position, or is that outside of the scope of this kind of a change?
If you're a lessor, it would not come off your financial statement. And I apologize, my screen has shrunk and I can't find the button to stop sharing my screen. So Sarah may have to come over and help me, but there it is. We back?
Yep, you're back.
Okay. The asset would not come off the financial statements if you're a lessor. What could happen is, yes, the person you're leasing to would record an asset and a liability for the right of that facility. And there's the potential that you could record a receivable and deferred revenue on the lessor side for that leased facility.
Okay. Thank you.
Other questions? If not, thank you very much. And next item on the agenda is COVID-19 update, and Gretchen is substituting for Chip.
Thank you, Trustee Ann. Thank you for having me here today. Once again, I'm here as the Deputy Incident Commander on Chip Gavin's behalf. Overall, the university continues to monitor, plan, and respond to the COVID-19 pandemic through individual institutional leadership and in conjunction with the incident command structure. Overall, the university has not had any significant pandemic-related interruptions this semester, and we're enjoying a more robust in-person experience this semester. In terms of the University of Maine system's current vaccination rate, as of this morning, we're at 93.1% overall. So that's great news. In terms of the student in-person population, 99.1% of our fall student in-person population is fully compliant. That breaks down to 92.7% of the in-person student population being vaccinated, and 7% either having an exemption or they're fully online. The residential population has a vaccination rate of 97% so far. And from an employee perspective, 92.2% of our full-time employees are fully vaccinated. Overall, the university's positivity rate for the period of August 1st through October 26th, so as of yesterday, is approximately 1%. In comparison, the state of Maine positivity rate for all testing in Maine, as reported by the Maine CDC, has generally ranged between 4% and 7% during the same period. For the most recent last 2-week period of time, the university's positivity rate has continued to move in the right direction, and we're actually down to 0.62% positivity overall. This can be attributed to the university's test, trace, and isolate approach and other risk mitigation strategies being employed with the support of the trustees, which includes our face covering requirements, vaccination requirements, student and employee engagement, and more. It's also important to note that the face covering requirement was recently extended through the end of the fall semester. In terms of asymptomatic testing, we continue to require individuals who are not fully vaccinated, but in person to test on a weekly basis or when they're in person. And those who are fully vaccinated are also welcome to participate in our testing as well. This month, October, represents the highest volume of testing we've had since April. We're also quickly closing in on conducting 200,000 tests overall since the start of the pandemic. That is no small feat, and it requires extensive planning and man hours to run those testing sites on each campus. So special thanks go to the campuses for their extensive efforts to support testing and these risk mitigation efforts. And with that, I'll open it up to see if anyone has questions related to the university's pandemic response.
Questions on COVID?
Mr. Chair, I have one question.
Go ahead.
I'm wondering about I think it was really smart to extend the face coverings till the end of the year. What is the timeline for making decisions about the spring, right? Because they'll come back till what, the second or third week in January. So is it the idea that you'd make the decision before students went home for break, or I'm just curious about, or what, either what's the timeline or what guides that decision?
Chancellor, I think you wanted to speak on that.
Yeah, we have discussed that. We will set a date by which we will make that announcement. And If I had to make a guess today, it would be that we would further extend it. And I think that timeline would be sometime in February or early March. But we have calendared that decision. We understand that we need to make that.
Thank you.
Other questions on COVID? If not, Gretchen, would you like to go on to enterprise risk management, please?
Sure. All right, I will segue into my role as the Director of Risk Management and Real Estate for the university and provide an update on enterprise risk management. So overall, we are currently monitoring 19 enterprise level risks for the university. One of those risks, number 11, has been assigned to the Audit Committee for oversight. It's important to note that the formal review of the enterprise risk matrix with the board committees was paused in fiscal year 21 due to pandemic-related activities. That pause has concluded, and risk management plans to provide regular updates to the board committees in fiscal year 22 and beyond. An outline of the scheduled updates is included on page 183 of the handouts for your review. And the next committee meeting that we plan on attending and providing an update is for the Human Resources and Labor Relations Committee in January. In terms of the risk that's been assigned to the Audit Committee for oversight, it's the credit rating downgrade resulting in increased cost of capital and potentially hitting the state debt cap. Control strategies that are currently being employed to mitigate that risk include, but are not limited to, ensuring that revenue funding streams are identified to fund our debt service payments on any new debt acquired by the university. We're also conducting regular monitoring of financial conditions and maintaining a rigorous budget process. All the previous presentations regarding the audits fully support that effort as well. Another way that we can assess the effectiveness of these control strategies is the S&P Global Ratings Report, which you may recall Vice Chancellor Lowe provided an update in September of this year on that report. That report indicated that the long-term financial outlook for the university is stable. And the report also indicated that the University of Maine System Management maintains a disciplined debt policy, in parts fiscal discipline through using dashboard indicators and long-term financial planning, and adapts to the challenging demographics of Maine through newly developed initiatives. So it's important to note that many other public colleges and universities have struggled to obtain such a positive rating. And this not only reinforces the control strategies being employed by the finance department, but it's also a testament to the focus and dedication of that finance team. So in closing, the long-term financial outlook related to this risk is stable, and risk management plans on providing a comprehensive update regarding the enterprise risk matrix overall in May of 2022. So with that, I will open it up to see if there are any questions.
Any questions of Gretchen? Seeing none, I thank you very much. And the next item on the agenda is executive session with the auditors. And could I have a motion for the Board of Trustees committee meeting to go into executive session under provisions of 1 MRSA section 4056E to consult with its attorney concerning legal rights and duties of the university. Could I have a motion?
So moved.
Second.
It has been moved and second. Alan, did you get that? And could you call the roll, please?
Certainly. Trustee Bartholomew,
Yes.
Trustee Kane,
yes.
Trustee Donnelly,
Yes.
Trustee Irwin,
Yes.
Trustee Gardner,
Yes.
Trustee McMahon,
Yes.
Trustee Martin,
Yes.
Trustee Mishu.
Yes.
The motion is carried.